welcome. In this video, we will continue our discussion on the option strangle by looking at an example of a strangle trade on Bank of America. A long strangle is a trade that combines two out-of-the-money options on the same stock, a long call and a long put, both with the same time of expiration. At the time of making this video, Bank of America is trading for $17.25 per share. A trader could place a strangle by buying a call option with an $18 strike for 27 cents a share, and by buying a put option with a $16 strike for 17 cents a share, for a total cost of 44 cents a share up front. Both options cost 44 cents up front total, so for the trade to be profitable, the price of Bank of America either has to rise more than 44 cents over the $18 call strike, or the price of Bank of America has to drop more than 44 cents below the $16 put strike. This means that for the trade to make money, the price of Bank of America either has to rise over $18.44 or fall below $15.56 before the options expire. In other words, the price of Bank of America has to either rise more than $1.19 or fall more than $1.69 from its current price. A trader could also go further out of the money and place a strangle by buying a call option with a $19 strike for 5 cents and buying a put option with a $15 strike for 9 cents for a total cost of 14 cents a share up front. Both options cost 14 cents up front total, so for the trade to be profitable, the price of Bank of America has to either rise more than 14 cents over the $19 call strike, or the price of Bank of America has to drop more than 14 cents below the $15 put strike. This means that, for the trade to make money, the price of Bank of America has to either rise over $19.14 or fall below $14.86 before the options expire. In other words, the price of Bank of America has to either rise more than $1.89 or fall more than $2.39 from its current price. The second example uses options that are far out of the money. For this trade to be profitable, the price of Bank of America must make a significant move in one direction, meaning that the probability of the trade making money is very low. However, if the price of Bank of America does make a significant move, the profit as a percentage of the amount risked can be very high. In this example, the price of Bank of America has to either move up almost $2 a share, or down about $2.40 a share, or the trade loses money. But if for some reason Bank of America were to move, for instance, $3 a share up to $20.25, the profit would be the current price of $20.25 minus the strike price of $19 minus the 14-cent cost for the options, meaning that the profit would be $1.11 on a 14-cent trade. In other words, the profit would be about 8 times the amount risked. This type of trade has a very high possible reward combined with a very low probability of success. As one buys options that are further away from the current stock price, the cost of the options decrease, meaning the possible profit as a percentage of the amount risked increases, but the increase in possible profit is directly offset by a lower probability of success. I hope you enjoyed this video. Thanks for watching.